All right, welcome my friends to part 2 of the financial planning tutorial using the right capital software. So now we're going to go into the other tab for investing. If I can reduce myself here. So we have the investment tab. Before we do that, I actually want to go back to the dashboard though, and I want to switch out their investments from just a total stock index. I want to go and make it actually the VASGX, which is the Vanguard Life Strategy Growth Fund. So let's change this around a little bit here. We're going to delete that, and we're going to say add holding for Bob, VASGX, Vanguard Life Strategy Growth Fund. It populates a share price of $34.68. We want them both to have $250,000. So we take 250 divided by 34.68. That means they have 7,208 shares, 7,208 in shares. So that's about right. So now we'll go to, that's Bob's. Now we'll go to, did I hit save? Yeah. All right. So now let's go to Jane's here. We'll do the same. Click on that guy. We're going to say delete that. We're going to add holding VASGX. Oops. GX. And 7208. All right. And let's save that and save that. All right, good. All right, so now we're going to go up here. We already did the dashboard. Now we're going to the investment tab. And what you'll see is it breaks it down. It says, look, this is the way you're currently allocated right here. 78 to 22 in terms of stocks versus bonds. Of your stocks, 46% is U.S., 24% is international, 5% is emerging markets, 3%. That's just a good diversified portfolio. You just can't beat that. A pure growth portfolio, according to the model, would be a little bit different. This is the growth portfolio according to the model. This is the Vanguard thing. I frankly could care less about the model. I just pay attention to what we currently have. But it's nice to see it. So, hey, at the end of the day, if you want to rebalance it, this is what you need to do according to the model they have. You say you have, drop your U.S. equities by 15,000, international equities by that, add 4,000 to your emerging markets, blah, blah, blah. Don't care. I just, you have this one-stop fund for Vanguard, and you are good to go. Our annual return is 6.2%. That's important to understand. We're not swinging for the fences here. We are literally using the Vanguard numbers, which is pretty low, pretty conservative. At the end of the day, the Vanguard numbers, if you watch my YouTube channels, you'll know they're expecting stocks to give you between 3 and 5% real return over the next 10 years. And so that's kind of where we're shooting at. We aren't swinging for 10, 12%. And if you were to do that, you can make your portfolio look fantastic in terms of retirement plan. Junk in, junk out, my friends. I can't stress that enough. I had a report. Let's just put it this way. A company I used to work for, not that long ago, we had a portfolio software that said you're getting 4% on cash, 6.2% on a 20 stock, 80% bond portfolio. And I'm just sitting there thinking everyone is having 100% retirement success. Well, hell, I can make you have 100% retirement success too, putting under your mattress, all your cash under your mattress. If I say you're getting 10% a year, it's crazy. But anyway, so just remember, if you're using financial planning software and someone says you're doing great, what are you basing that on? What's the inputs? Because the outputs don't matter if the inputs are junk. All right. So, and if you want, now here we're just saying all accounts. We're combining John or Bob and Jane's account. You could look at Bob. Now, this is going to be the exact same thing because they're the exact same holdings. But let's just say Bob is conservative and Jane's aggressive. Jane's account looks different than Bob's. I mean, it's kind of interesting to do that. You can do that for sure. And then, of course, you can do it relative to a balanced portfolio. If you do a balanced portfolio, it'll tell you need to revisit that in terms of what you should have instead. Instead of 46% U.S. equities, only 32%, and blah, blah, blah. You can see all that. All right, and then we go to detail. And this is pretty cool. It just basically breaks it down. And this is why I love the Vanguard Life Strategy Fund. One-stop shop and you're done. You can't beat it. They're saying, see, I just don't care that much about their target. I just like what they have. They have a target of only 12.5% international. My target is higher. I think international have more upside than domestic simply because the valuations are lower. But, I could be wrong. But anyway, Vanguard agrees with me, so I'm going with the Vanguard. It just breaks it down for you. It's pretty cool. And then you can go down here again to see what they say, how you should rebalance it to get back to your target portfolio. All right, so now we got sector and style. This is pretty good. And again, guys, I'm not a huge investor. I just think set it and forget it. Get a good diversified portfolio, be done with it. But here, if you're so into this, you can say, look, compared to a broad index, we have your portfolio has 18% financial services, the market index about 14%. We're underweight healthcare, we're overweight a little bit of financial services, but we're tracking pretty good. I don't even know what the broad index they're using. I guess they're using a total stock index. I have literally no idea. So, and again, I leave it with the Vanguard. They'll make the choices. I'm very comfortable with that. Equity style. This is from kind of Morningstar used to do this. We're in the middle on the between mid and large cap of stocks. All right. So this equity style comparison, where basically we have some exposure small, probably a little bit less than I'd like to see, a lot to the large, and then a middle round in the mid cap. But 8 was at 6% small, 18% in mid, and then the rest in large. I'd like a little bit more small, but it's not worth it for me to go and picking funds and all that. Just no reason to do that. So I'm pretty comfortable with that. But if you were to do this and you're large up here, like in 1999, you had 60% large growth, you'd have a problem. You need to know. We want to make sure we have something on base in each of these tic-tac-toe boards. You can't have zero someplace. You could, but we don't want to. We want to have something in all of those right there. All right, let's go to concentration. This is pretty cool. You're 100% diversified. So I had a lady not that long ago. She had, I think, 70% of her investments in one stock. And that scared me. She was a stock she inherited from her dad. And so it had some sentimental value there. But when I looked at it, I said, man, they're taking on debt in order to pay dividends. That scares me to death. Cash flow is shrinking, debt's increasing, the profitability is shrinking. Something's going to give there. And I said, look, I don't care if you only have 10% of your portfolio in it, but having 70% is risky. And she correctly sold quickly to be diversified. And if we would have run this, it would have said you're way too concentrated in one position, which is one of the reasons I love this software. Tax out, this one right here is great. All right, so there's 3 buckets of investments. You got your T for taxable, your TD for tax deferred, and your TF for tax free. When you hit retirement, we want big on TF and T, and we want minimal on TD. That's what we want. We want these 2 guys to grow, boink, boink, and we want this guy to shrink. That's what we want. And we'll share it with you on the tax scenario here in just a second. And this doesn't give you anything for action items because everything we have right now is in tax deferred. That's the investment part of the right capital. So I'm going to take a break, go get some water, and then we'll come back and do my favorite, which is retirement. We'll go a little bit in insurance. We're going to skip the education. We'll go to all. Actually, we'll just go to all, actually, except for education for right now. We're not going to use that. That's the investment side of the portfolio. Hope you like it. So again, stay tuned. We got a couple more to go. And this is just to show you it. And then once we go to some other ones, we're going to show the details of what it looks like in the future when it comes to your own retirement and some of the strategies you can take to minimize your taxes and increase your tax flow. All right, we'll see you here in just a bit.